This TFMR podcast is brought to you by your friends at JM Bullion. Visit jmbullion.com for all your gold and silver bullion needs. Welcome back to your TF Metals Report podcast highlights for the week of March the 6th through March the 10th, 2023. A week that we knew was going to be very volatile. As the week progressed, we were going to hear from Chairman Jerry Powell, and we were going to get the latest updates on the jobs report in the U.S., culminating with the latest BLS-BS jobs number from the U.S. on Friday. So we knew it was going to be a very volatile week, likely to move one way early in the week and the other way in the next. Could we finish in the green? Well, a lot of that was going to be determined by which way the dollar index moves. And as you probably know, how the dollar index moves is largely determined by which way the euro is moving, as the euro is the most heavily weighted currency in that basket within the dollar index. So that's something we got to keep an eye on. And on Monday, March the 6th, we took a look at the chart of the euro. As you know, the dollar index is heavily weighted toward the euro, 57, 58%. So how the euro trades in large part determines the direction that the dollar index is going. And here's the euro, last 4 days, banging up against this 107 level. And as you can see, going back to December, that's kind of an important level. And once it got through 107 in January, look how it rolled all the way up to 110. And remember how well gold was doing back in January. So let's watch 107. It tried to hold it as support, then that gave way. It fell a couple weeks ago down here to almost 105.5. Now banging up against 107 again. Let's watch 107. Gets through there, it could go to 108. All right, well, that doesn't sound like much, but what would that do for the dollar? Another thing we're watching very closely at TFMR in 2023 is the yield curve. Everybody knows it's inverted, and inverted at levels we haven't seen in over 40 years. It's a sure sign of an impending recession, but when will that recession begin? What we have found over the years is the recession is underway once the yield curve begins to uninvert, move back toward being flat. So we got to watch for that to happen in the weeks ahead. One of the things that might drive that would be weakness in the stock market, get rotation out of stocks into short-term bonds for safety. So all of that combined into these three charts that we discussed on Tuesday, March the 7th. This is the 6-month T-bill. Like I said, up 17 basis points today, 529 when I printed this. I put the little crosshairs on here almost exactly a year ago. This thing was 70 basis points, 70.7%. And now it's 5.3%. Look at that. Crazy. Even back when it peaked in 2018 and there, and the liquidity's drying up, the stock market's collapsing, it was 2.5. Now it's fucking 530. Utterly remarkable, frankly, that gold is still $1,800. And it is. All right, the 2-year note looks the same. Look at that. It's just crazy. A year ago, it's in here at 1.25, and now it's 5. You go back to November of 18, Fed pause and pivot and all that stuff. It was 3, and now it's 5. So what happens to the stock market? I mean, we've been talking about this lately. I mean, at some point, it'll feed on itself. The stock market starts to go down. If it starts breaking through this old trend line, as you see here, starts breaking down below 3,800, well, then why the hell wouldn't you go, well, you know what, screw this. I'm going to dump half my stocks. I'm going to buy myself a 6-month treasury at 5.3%. Take my 5%. If I'm a hedge fund, I can lever that fucker 6 or 7 times. That's a pretty good deal. And that becomes kind of self-fulfilling. And that will be when short rates have peaked. They start coming down. Long rates hang in there. Because of inflation, all of a sudden we're back to 50 basis points inversion. And again, why I showed you that chart of inversions in the past versus recessions. If you're an avid listener to these TF Metals Report podcast highlights shows, then you know we keep a pretty close eye on copper, particularly here in 2023. As copper shortages appear to be on the horizon, and if copper can find strength and break out higher as the year moves along, what's that going to do for silver? So we're keeping an eye on copper. So far, it's been holding above its 50-day moving average. A drop last week, then it quickly recovered, but then another drop this week. So copper needs to get back above that 50-day if it's going to lend some support to silver. And that chart of copper was something we discussed on Wednesday, the 8th. All right, we're going to keep watching copper. No doubt about that. $3.95 clear support after it had been resistance for the final 2 months of 2022. It's where it bounced a couple of weeks ago, the first time it broke down through its 200-day move or 50-day moving average. It immediately bounced the next day, and that's what happened today. It broke down again yesterday and then bounced today from identical candles. So I'll sure be curious to see what copper does tomorrow. A lot of it's going to be determined by what the dollar does. I mean, you know that. But it would be nice to see copper get back above that 50-day. Again, just to lend some strength to the precious metals. As you know, access to TF Metals Report is a whopping 50 cents a day, or about $15 a month. You get these daily podcasts. You get a updated summary of the news events and everything else that's going on each morning. And you get access to the community, which is fantastic. All of it making a whopping $15 a month. Quite a bargain, if you ask me. But maybe I'm biased. Anyway, we always try to have some free content too. Some of that free content is what we call a Thursday conversation, where just about every Thursday we record a podcast with some mover, shaker, economist, industry specialist, you name it. And on this Thursday, March the 9th, I spoke with my friend Steph Pomboy. Steph runs a great website called macromavens.com. She's an economist, a macroeconomist, and someone that you should get to know. So it was a pleasure to introduce her to TFMR on Thursday. And here's just a very brief snippet of some of what we discussed.
One thing I track, Craig, because it's really hard to get super timely information on the broad market rather than just anecdotal things like the PIMCO default and that kind of stuff, is you can look at corporate ratings, upgrades, and downgrades. And last year at this time, let me just make sure I got this right. I think the junk bond market had upgrades outpacing downgrades by a 2-to-1 ratio. Today, downgrades are outpacing upgrades the other way. So you went from a 2.0 upgrade downgrade ratio to now you're at a 0.6 upgrade downgrade ratio. So in 1 year, the quality of credit, at least as rated by the ratings agencies, has deteriorated dramatically. And that's not at all surprising, again, given the run up in interest rates and the limited ability of companies to service that debt. And I would add here, since I mentioned the cash on the balance sheets of Apple and Google, et cetera, that one error that people tend to make when they look at the markets broadly is they look at the average statistics. So they'll look at corporate balance sheets and they'll say the corporate balance sheets are strong because they're looking at aggregate statistics. The S&P, I guess they're sitting on a combined $2 trillion in cash or something in that area. Well, the top 10 companies in the S&P have more cash than the bottom 400 companies combined.
Yeah.
So it's not the average company. There are 10 companies that have all the cash and everyone else has nothing.
Right.
So this is going to be a major flashpoint, I think, as these interest rate hikes begin to bite.
And on Friday, March the 10th, we end the week with all sorts of stuff going on. First, the latest U.S. jobs report showed exactly what we've been waiting to see, an uptick in the unemployment rate and a decrease in average hourly earnings. Put those two together and all of those rate hike anticipations that ramped up back on Tuesday have been completely taken back out. And as such, gold soared with the dollar falling sharply and interest rates coming down too. Now, there's more than that going on. This concern about a banking crisis in the U.S. is likely to spread over the weekend too. And so putting it all together, gold's up 2% on the day and now actually green on the week at TF Metals Report. As we looked ahead to this week, we said, you know what? Whatever happens early in the week will probably be reversed by the end of the week. That's exactly what happened. We went down hard back on Tuesday, but now COMEX Gold is going to finish the week up $14. How about that? Nice green weekly candle. And actually a higher level than it attained last week, with a little double bounce off of 1820 and the 200-day moving average. Now, the 50-day moving average and natural resistance at 1880 will be next. It's going to be tough for gold to get through there. But if things get out of hand next week, and if the next week's CPI report comes in more tame than expected, we may just exactly do that. So be ready for another volatile week next. and come back next Friday for another edition of your TF Metals Report podcast highlights.